Hi, everyone. I'm Catherine Anaya. Welcome to the Women's Eye podcast, where I chat with remarkable women who are leaving their mark, making a difference, and changing lives. This episode is brought to you by CASCO Financial Group in Phoenix, Arizona. Catherine Scrivano is the president of CASCO Financial Group. She started her business to help people create the financial strength they need to achieve their dreams. She believes you don't have to be wealthy to be wise. And Catherine Scrivano is my guest today to talk about offsetting the financial loss of divorce, particularly what she calls gray divorce. It is good to see you, Catherine.
Great seeing you.
Well, let's just dive right in because this is a great topic. You've said the divorce rate among adults 50 and over has increased significantly. So let's start by talking about this gray divorce phenomenon, as I've heard it called. What's been happening the last 25 years and why?
You know, the increase is not insignificant. It's 109% in the last 25 years. So, of course, every situation is unique. I want to be very clear that we honor and understand that every time, and the emotional impact is not something to be taken lightly either. But as I always say, there's a financial component to most every part of our life. And that's something that we focus on, is lessening the financial impact of major life change like divorce. One of the things that's happened in the last couple of years, of course, is that people were living more closely together. They weren't separated during the day by traveling to work and that kind of thing. And sometimes it removed that distraction that let them uncover some incompatibility that they've been living with, maybe silently, just not wanting to tolerate that anymore. Another thing, when we talk about gray divorce, often it's when the kids move out that people find that they just don't have that shared focus anymore. And society is frankly more accepting of divorce than it ever has been.
That is for sure. And I read that the financial fallout is becoming greater for women. Mm-hmm. What's contributing to that?
Well, when divorce occurs later in life, generally there's less time to recoup from the financial impact or recovery necessary. But interestingly, the US government did a study in 2017 that said the male income tends to drop about 25%. Women's income tends to drop about 40%. And that's very dramatic. Regardless of at what age couples divorce, that's a huge setback, especially for the women.
It certainly is. And we know that, like you mentioned, divorce is already emotionally difficult. Add to that financial impact, and it's just so overwhelming. And that's why you believe now more than ever, women need to make sure their finances are on the right track with building blocks in place for that solid financial future. So at what point in the relationship should that begin?
Well, to be honest with you, I'm so pragmatic. I think it begins the day you make the commitment. We have talked in the past and hopefully in the future about how couples negotiate financial issues. But if a divorce is imminent or even potentially imminent, I encourage people to really pay attention to the dollars. This can lessen the negativity around divorce that, frankly, is somewhat inevitable, but also lets you put the past behind you, get in place the building blocks you're going to need for the foundation for your new future.
Mm-hmm. So one of the steps that you recommend is to assess your current financial situation. So what are some things to consider?
That's always what I start with, isn't it? Is just identify, look around and see where you are right now. You'll need to get a handle on your finances, assess your current financial situation, and then think about the likely loss of your former spouse's income. And now that you're probably going to be responsible for paying expenses that you used to share, like housing, utilities, car loans, those kinds of things, if those are going to be wholly or even the majority of your responsibility, you need to see how that's going to affect your day-to-day life. Ultimately, you may come to the realization that you cannot have the lifestyle now that you were accustomed to before the divorce. And that old adage that two can live as cheaply as one is not actually correct, because if we take it to a per person basis, it's somewhere between 40 and 50% higher to live as an individual than it is as a couple.
Yes. So no matter which direction you end up going, it's all going to require a spending plan.
Yeah,
So
absolutely.
so what is the best place to start with one so that it isn't so disciplined and so rigid that you end up just tossing it?
Well, that's true whether we're talking about impending divorce or just day-to-day living as we are right now. That rigidity and lack of flexibility will tend to make people fail. Looking at their spending plan somewhat pragmatically, not making any judgments about right or wrong, good or bad, and certainly not carrying resentments into the plan as we talk about divorcing. I think it's really critical. Just look at numbers, assess numbers, and be realistic. Because again, in the case of divorce, and this tends to affect women more than men, there are some tasks that may have to be paid for that right now are being done without an impact to the monthly budget. I'm talking about things like tutoring children, maybe caring for elders, house cleaning, cooking, those types of things, the domestic things that maybe a spouse used to contribute to time-wise that now you may have to contribute to financially. Mm-hmm. And at this stage, as we're developing our spending plan, we're just identifying those things.
Mm-hmm. Well, and there's also the fact that sometimes your financial goals change post-divorce. So it's important to reevaluate and reprioritize what those financial goals are. So, and this is key because coming out of the divorce, if that happens and your goals do change, and oftentimes they do, because they're just not the same as when you were a couple. I mean, what goes into making sure that you reevaluate and reprioritize, in the right way?
Well, I think the first place that we start is looking at expenses and identifying what are fixed versus discretionary expenses. So the discretionary expenses are where there's some wiggle room. Fixed expense is going to include things like housing and food, transportation. Discretionary might be things like entertainment and vacations. And so as you start out as an individual person, your goals around those discretionary expenses probably will be different than they were when you were part of a couple. But again, as you mentioned earlier, you said something very profound, that it's important to build that occasional reward into the budget, because that's going to reduce the likelihood of you abandoning all of the discipline it takes to live within your means.
That's so important. Absolutely. You have to give yourself a little bit of a break sometimes. Mm-hmm. And you know, it goes without saying, and it's always a good reminder that you need to take control of your debt, avoid credit cards when possible. And if you have that debt, put a plan in place to pay it off as quickly as possible. Do you have maybe a best tip for going about doing that?
Well, believe it or not, the first tip is a reality check. Acknowledge the debt that you may come out of a divorce with. There are times when each is pointing at the other with the assumption that they'll take that on. And that's something that tends to be negotiated pre-divorce. But once those decisions are made, acknowledge those balances, acknowledge those interest rates, keep track of them, and have a plan in place to manage your payments. It's critical that you're avoiding late fees, that you are using credit to supplement your monthly expenses and just going deeper and deeper in debt, and identifying the highest interest rates and tackling those debts first. Mm-hmm. And these are all strategies that are doable and manageable. The wiggle rooms generally has to come in how much time it's going to take. We'd all like it to happen the day after tomorrow. Realistically, it may take a little longer, but just the reality check, I think, is the most important place. And paying attention to the impact to your credit. Because
Yes.
if you don't tackle this in a good way, you're going to have a negative impact to your credit. And that can take years to recover from.
Mhm. Well, and I've seen people who have come out of a divorce with a negative impact on their credit rating as a result of the divorce. Is there something you would recommend to protect your credit record and or establish credit in your own name?
Well, the first thing is to check your credit report. You can go to annualcreditreport.com for a free credit report from all of the credit reporting agencies once a year. Do not go to freecreditreport.com because, believe it or not, you have to pay for that one. So annualcreditreport.com is where you want to go. Identify accounts that are legitimately in your name and your responsibility, and get off of any accounts that are perhaps no longer your responsibility. And staying on top of that. Remember that a lot of times even employers are checking your credit. This may impact your ability to earn a living going forward. Again, making sure to keep a good track record with your creditors. If you need to ask for some forbearance, just stay in touch with them. Let them know. Creditors are so often thrilled to be working with clients who are making an honest attempt to repay, that they will negotiate terms and interest rates and payment schedules. And that allows you to keep your good name and good credit.
Well, there are so many things to consider: insurance coverage, updating or creating a will, taking action on tax implications of divorce. Just a lot of issues that need to be discussed and taken care of and addressed. And that's why it's important to hire a financial advisor if you don't already have one, right?
I think that it's a critical part of the process. Again, my goal personally is to make this as non-contentious and as painless as possible. And one of the things that can be done is hiring a financial professional who will introduce topics thinking about the tax implications of your divorce. You may, depending on your filing status, may choose to accelerate or delay the actual date of the decree and save some income taxes. There's a lot of subtleties, naming beneficiaries, changing beneficiaries, life insurance, for instance. If someone is paying child support, probably want to make sure there's life insurance in place that could replace that child support if that person were to pass away. These are things that a financial professional can bring up, help you consider what your options are. And then if you're working with an attorney, they can help document that and write that into the agreement. Even if you're doing a do-it-yourself divorce, chances are good that there's considerations that a financial professional may bring up that you wouldn't have thought of otherwise.
Yes. Such a great discussion, Catherine. Thank you so much for all your valuable information and advice. Certainly appreciate it, as always.
Of course, happy to be here.
You can learn more about Catherine Scrivano by going to our website, thewomenseye.com. And I also want to let you know that Women's Eye has 2 books. The first is called 20 Changemakers. You can shop for it wherever you buy books and at changemakersbook.com. And our newest book, 20 Women Storytellers, is out right now, and you can find out more about that at womenstorytellersbook.com. That's going to do it for this episode of the Women's Eye podcast. Thank you so much for joining me. I'm Catherine Anaya. Until next time, it's the world as we see it.